Hey everybody, so I get a lot of questions on CDs versus MYGAs, multi-year guarantee annuities, and I get a lot of people with lots of misconceptions, especially in the comments. So I wanted to, do the new version of Googling what's the difference between CDs and MYGAs. I used AI, ChatGPT. There's a lot of resources out there now, and I was actually very surprised at the results I got back from AI. It was a lot less biased than what we find on the general Google searches. So let's dive into this one by one and take a look at the differences between CDs and MYGAs without the bias of a salesperson or an agenda in this case, okay? So it came up with this great chart. It's a very long chart, so I have a few slides here, but we're going to go through one by one and take a look at what it came up with. So issuer. Well, bank CDs are issued by, in this case, FDIC insured banks. There are banks that aren't FDIC insured that do issue CDs. So that would be one caveat I would add to that. And then multi-year guarantee annuities. Well, that's insurance companies, and they make it more specific. State regulated insurance companies. We're going to talk a little bit about that. So regulatory protection, one of the big questions I get, well, how safe is my money in an annuity? Because everything always says backed by the claims paying ability of the insurance company. Well, that's not the same as FDIC insurance. Everybody understands their money's so safe in banks, they're FDIC insured, and we'll just get our money back. Well, I think some people have heard horror stories, but yes, the reality is your money is safe in an FDIC, as safe gets. That's the way I like to look at that. Okay. Can something happen? Sure. But if it's really crazy disastrous, then the US dollar is probably plummeting in value and it's not worth anything anyways. So the insurance companies, it went on to say the State Guarantee Association may provide limited protection and it varies by state. What's funny is the vast majority of states cover up to 250,000, but we're going to see why they have to dance around that answer of that question, okay? So then typical terms, 3 months to 5 years on CDs. I'll be honest with you, anything over, say, 18 months, you have to be careful. They do have call options on a lot of these CDs. And CDs are really not built to go past that 18-month range. So a year and a half is usually the farthest length you would typically go nowadays. Look, back in the 90s, I laddered my great aunt's portfolio in CDs because interest rates were so much better back then, and it was perfect. It paid for her long-term care, did all those kinds of things. There was a lot better choices for longer-term CDs back then. But when interest rates plummet, all those longer-term CDs, they got called due and said, here's your money back. 2 to 10 years on multi-year guarantee annuities. So this is why the longer term CDs have somewhat gone away, because the multi-year guarantee annuities have started coming much higher in popularity, and people understand them and know them better than they ever have in the past. So if you're going out for more 2 to 10 years, well, that's the strength of these multi-year guarantee annuities. And the vast majority of carriers issue them on 3, 5, 7, and 10-year increments. Minimum investment option, bank CDs typically have much lower minimums, $500 to $1,000 typically. And what you'll see in the multi-year guarantee annuity world is $5,000 to $10,000 minimums, depending. Sometimes higher interest rates will be issued for a minimum deposit of $100,000. So you get better interest rates with more money in a lot of cases. So these are the same animals. It's a fixed interest rate for a fixed period of time. A lot of people get these types of annuities confused with any other type of annuity. This is not a guaranteed income payout. This is nothing other than a CD with an insurance company. Okay. So I'm not sure where all these confusions come from. Well, I kind of know. We blend the whole world of annuities together, and all the bad things you've ever heard about annuities, well, it must be that way for all annuities, and it really isn't. So be careful about what our thoughts are doing to us. So interest rates fixed for the term in both cases. But what was interesting, which has been true for as long as I've seen these things out there, the multi-year guarantee annuities often have higher interest rates than CDs due to different regulations and tax treatments. I didn't add that. AI put that in there. And it is in fact true. We've seen much higher interest rates in the multi-year guarantee annuities consistently. Taxation of interest. Well, if you buy a CD, you owe taxes on the interest you earn as you earn it, and you get taxed at full income tax rates. Okay. Interest in a multi-year guarantee annuity is typically going to be tax deferred compounding. Okay, so what we'll see here is we have the ability to grow for a longer period of time without any taxation. That's going to build that wealth in a more efficient way, certainly than a CD. Early withdrawal penalties. Well, CDs typically are going to forfeit a portion of interest. So that's always something that we have to be careful of. So typically, unless you go to the longer ones have bigger penalties. The shorter ones have less penalties. Just remember that. And then may include surrender charges for multi-year guarantee annuities. So if you have a 5-year, you can expect something like 9%, 8%, 6%, 2%, something like that. And then after the 5th year, you have 100% access. And then there's also something called a market value adjustment, which is I could do a whole class on these things, and they're not all calculated the same. So these penalties can be larger because they're guaranteeing the interest rate for a longer period of time. And the reason that is that way is because they have to go invest this money in strategies that are going to make sure that they make at least that amount every single year. And so they're tying the money up. Whereas a bank, they're constantly rotating through credit card interest and stuff like that, shorter term type investing. The insurance companies are going to do longer term investing. So yeah, penalties will be a little bigger, but there's a huge difference. These multi-year guarantee annuities do have access options, meaning they're going to give you the ability to make withdrawals year to year if you need to withdraw money. And that's why we see them used in IRAs a lot more and in retirees' portfolios. You're not going to have 100% access, but you will have access to typically 10% of the account value each year. So every anniversary you hit, you'll have a fresh new 10% access. Okay. Whereas CDs, you have to wait till maturity to get your money back. So multi-year guarantee annuities, you have access to 100% of that money once you hit the end of the guarantee period, just like a CD. But along the way, you'll have access to money unlike a CD. So compound interest. Well, bank CDs are typically simple interest, okay? And some offer compounding interest, whereas multi-year guarantee annuities are the flip-flop of that. They are almost all compound interest, whereas some will offer simple interest. And I'll show you those interest rates at the end. We also have to remember this is tax deferred, so we're compounding and tax deferred. That's, compounding on top of compounding. Creditor protection. Bank CDs really don't have creditor protection. You pass away with a whole bunch of bills, that is part of your estate. They will have to pay those bills. You get sued, they can access that money. Whereas multi-year guarantee annuities have been tested time over time. Go look at O.J. Simpson's case. He lived very wealthy. He owed the Goldmans lots of money, but he lived very well after losing the lawsuit to the Goldmans. And the reason he didn't have to pay them is because he moved all of his money into annuities and life insurance. So guarantees are specifically to the states that you're in, but many of the states give you lawsuit and creditor protection in the annuity space and life insurance space. Bank CDs, hard to find, and that's what I would adjust here. Hard to find CDs that allow you to put them in their IRA. Brokerage CDs, as opposed to the cornerstone banks, That's where you'll find that flexibility. Multi-year guarantee annuities, quite often that's where we will find this type of investment. It is a great replacement for a bond portfolio, for instance. And so where you need those safe, stable investments is where you're withdrawing from, and retirees need to withdraw from their IRA fairly regularly. So that's why we end up finding them quite often in IRAs. So yes, you can use these investments in IRA. Purpose. Well, and again, I didn't come up with any of this. I just asked them to compare and contrast CDs versus MYGAs, and it came up with purpose. Well, short-term savings and income. That's what CDs are for. So you look at it around that 1 year increment. You just keep flipping 1 year after 1 year after 1 year, and the issue with relying on income from that is if interest rates go down, you're going to make less income. So it's not guaranteed income. Whereas multi-year guarantee annuities, they say long-term savings, retirement income planning. Well, okay, I somewhat agree with that. And again, when I talk about income, this is not considered guaranteed income. This is what I call passive income, which I've done a lot of classes on and little videos for YouTube. Passive income means you're going to receive the yield. If you need it, you can withdraw it. If not, you can leave it in there and let it compound its growth. So when we're planning out a portfolio, typically, especially a retiree is going to need safe investments in the long term, not just, I want some safe investments today. Right? You're going to need a certain portion of your portfolio in safe, stable investments, and better yet, ones that you can withdraw from, and that's what these meet. That criteria is matched very well with the multi-year guarantee annuities. Suitable for liquidity and capital preservation. So they said this about the bank CDs, suitable for liquidity and capital preservation, which I think is fairly interesting. Certainly, I agree with capital preservation. Liquidity is, well, you're going to have to ladder these short-term ones. That's what you're going to have to do. So you'll have access every year is really what you're doing. And that's so temporary and short-term to me. So we have to go back to the purpose and say, yeah, this is only for short-term placement of funds, right? It shouldn't be an investing strategy for a portfolio, because what are interest rates going to be when these things mature, and you're constantly flipping through them and flipping through them. So it makes it less reliable to rely on it for income. So when it comes to the multi-year guarantee annuities, suitable for retirement, suitable for income planning and long-term growth without market risk. I didn't write this. So I found that an interesting verbiage that they put in here. Suitable for income planning. Absolutely. When you're building a portfolio to provide for you in retirement, you can build a passive income portfolio. Okay, that's the yield you're going to create, and you're going to be able to rely on this a heck of a lot better than these short-term CDs, because you can lock this in all the way out to 10 years. So you can guarantee that income coming into you. It's just not guaranteed for life. So good way to plan out a portfolio, and you can even ladder these so you don't have it all expire in the same year. So that way you're mitigating the risk of interest rates being lower. And long-term growth without market risk. Well, yeah, it's a flat fixed interest rate for a fixed period of time. And the big advantage for long-term growth here is that compound tax-deferred interest. Okay, so next we've got distribution options. Well, again, lump sum. Once the term is up, you have access to 100% of the money. And I don't know why this is hard for people to understand. A MYGA, multi-year guarantee annuity, is a CD from an insurance company. That's it. At the end of the term, you have 100% access. You can move it anywhere you want. Okay. Systematic withdrawals. You could just tell them, hey, pay me the interest every 6 months or once a year or every month. A lot of these companies have no problem systemizing this and giving you the systematic withdrawals. Okay. And then annuitization is something very specific to annuities. If you want to turn it into guaranteed income, you certainly could. There are better tools for that, but this does have that option. Bank CDs, lump sum, or periodic withdrawals. Well, the periodic withdrawals, I kind of, what? Well, some of these bank CDs, if they are able to be put in an IRA, they will allow you to pull out your required distribution typically. Whereas all multi-year guarantee annuities, they will all allow you to take out a required distribution. Risk profile, well, they're both very low risk. All right. So again, I like to say as risk-free gets. It's just as low risk as it gets. Bank CDs with the FDIC insurance, well, as you'll see again, we have very similar coverage in the multi-year guarantee annuities. And it says, because they have to, dependent on the insurer's financial strength. So there's some caveats there. When I saw that, I'm like, well, I got to ask some further questions. So the next slide will kind of break through, actually 2 slides, it'll break through that. So then Medicaid asset shielding, well, I didn't ask for it to tell me this. This is counted as an asset as a bank CD. The vast majority of multi-year guarantee annuities, no different, but there are ways to structure this so it receives favorable treatment for Medicaid planning, okay? That's not me, they volunteered that information. All right, so then it went immediately into, after the big chart, it immediately went into key takeaways for retirees. And they said age 50 plus. I thought, I didn't ask for this. I thought that was quite interesting. So the MYGAs, in terms of tax deferral advantage, well, if you're in higher taxation, this can make a significant difference over time. Okay, especially for those in higher tax brackets. So the tax advantage can be used, but I always tell people that's a double-edged sword. Okay, if you're in higher tax brackets than your heirs will be, then great, let them pay the taxes on it. But the reality is somebody still has to pay taxes on it. So make sure we account for that. Interest rate differential. It says that MYGAs, multi-year guarantee annuities, often offer higher interest rates than bank CDs, particularly for longer terms. Okay, this has been absolutely true for a very, very long time. Creditor protection, that's the positive on the MYGA side, certainly better creditor protection than CDs have. Some of it's ironclad depending on the state. Liquidity considerations, CDs, well, you get access at the end of the term. So that's why people use these shorter terms. Whereas multi-year guarantee annuities allow you to have access during the term. So that allows you to lock in that interest rate for a longer period of time. So just make sure, and I'm going to highlight this, make sure you understand the access provisions that your MYGA has, because there are multi-year guarantee annuities out there that have zero access and they offer higher interest rates. So when you see advertisements and people flashing that, well, if it's a higher interest rate, you have to make sure that you have access to it if you need it. Retirement suitability. Multi-year guarantee annuities are more tailored for retirement income planning, especially within IRAs or as a part of an income strategy, a guaranteed income strategy. And again, I don't consider this guaranteed income because it's not guaranteed for life, but it certainly can be part of a yielding portfolio that is creating yield for you, just like a bond could be, or a qualified dividend could be, or any other yielding investment that you have out there. Risk of default. They're as safe gets. That's the reality. CDs, it says CDs are backed by U.S. government via FDIC, whereas MYGAs are only as secure as the insurance company issuing them. Choosing a financially stronger insurer is essential. So I saw that comment and I'm like, well, okay, clarify this. I say clarify the risk of default. Well, State Insurance Guarantee Association versus FDIC insurance. Well, FDIC, most people understand, federal protection up to $250,000 per depositor per institution, backed by the full faith credit of the U.S. government. Very clear, standardized, and automatic. That's the spiel we get. But I thought this was so interesting. So they put the State Guarantee Association for the MYGAs. Each state has a guarantee association that provides limited protection if the insurance company becomes insolvent. Typical coverage is the same $250 in present value of annuity benefits. And yes, it may vary by state. Some states actually go up to $300,000, and there's a couple of states that are down to $100,000 coverage. So very similar, not the same, but very similar. And that's the state insurance guarantee funds. Coverage is not federally guaranteed, it's state guaranteed. Okay, it's the state where it is written, where you got the annuity is what will control this. And very interestingly, not advertised by insurers, because in fact, they're legally prohibited from using it as a selling point. That is why they always have to say it's backed by the insurance company, and that's it. You are actually breaking the law if you tell somebody about this insurance. It's the most ridiculous thing ever as far as I'm concerned, because banks flaunt their FDIC insurance, whereas the state guarantees aren't even allowed to be talked about. And then they further say backed by the industry itself, not the government. Well, wait a second. The state insurance departments are the government. That's the government of the state. That is a governmental division of our state government. Okay. They dance around this stuff because somebody had to just put this in there. And when I say somebody, it was at the time that all this stuff was coming out. Well, the rules in the world we live in are driven by banks and the SEC and the stock market world, and they're all fighting against the annuity world. So you can see where some of this stigma comes from. The reality is that, yeah, these are all as safe gets. And I said, further clarification, how many nationally licensed insurance companies have become insolvent and not returned all client money? And it came back and said the short answer is very few insurance companies have failed and left policyholders with permanent losses, especially annuity holders. When insurers have become insolvent, state guarantee associations and receiver mechanisms, I'll explain that in a second, have generally stepped in to protect the consumers. However, there have been a small number of cases where recovery was partial, delayed, or not 100%. Okay? So the interesting thing about this is if a big insurance company is going out of business, they go into receivership. It's a form of bankruptcy. Okay? And in this form of bankruptcy, the first thing that's going to happen is they're going to sell this insurance company off to another insurance company. And if they have a national network, they typically get bought up right away. And in most cases, that's how these are solved. And in those cases, all the policyholders just get a letter saying, welcome to your new insurance company. We've bought them. And your policy is honored. That's really how most of these happen. And it doesn't happen that often. You can go back all through history and look at all the different cases. And the vast majority of them were honestly just long-term care insurance. That's the vast majority in recent history of insurance companies that have gone out of business. It has never been the annuity companies. These are pretty solid business that they understand the risks and the investing strategies behind this to be able to pay the interest that they owe. It's a lot less volatile than long-term care, risk-based insurance. Think of home and auto insurance, all the disasters that we've seen out there. Well, we don't get that type of stuff in the annuity world. It's much easier to understand. Okay, so let's look at this. Compound interest versus simple interest on the left-hand side. Look, I think we should all understand that compound interest, if your goal is just to grow your money, not build a portfolio to pay you income or any of that kind of stuff, if you're just trying to grow your money, then compound interest is always going to be better. Okay, and then we add the concept of compound interest and tax deferral. Well, that's just compounding on top of compounding. So we definitely prefer that. Now, On the flip side here, if you're trying to generate income, CDs typically pay out that interest, you owe taxes on it, and you can use that interest as income. Well, the multi-year guarantee annuity world has some of those simple interest ones as well. You can take that interest, you can enjoy it as income, but you got to pay taxes on it because you're pulling it out. Or you could leave it in and let it come, or it doesn't compound if it's simple interest, okay? But you could leave it in there and allow it to continue growing. So the interest rates as of the day I'm recording this video, 5/22/2025, you got the 3-year with no access on top and the 3-year with access to the money on the bottom. So you can see the interest rates are definitely different. When it comes to simple versus compound on the shorter term, there's not much of a difference out there, okay? Whereas you go to 5-year, 7-year, and 10-year, you're going to start seeing a much bigger difference in the simple interest, okay? So the 5-year, you can get 6% compound if you don't need to touch the money for 5 years. Okay, not a lot of people are in that situation, but maybe you're looking to replace some bonds in your IRA and you're 50 years old, not retired, and you want some safe, stable investments. Well, then that's not a bad choice for you. Simple interest rates, 6.45. So if you're looking for it for income, go tell me, is there any CD out there paying 6.45? The answer is no. I've never seen anything remotely close to that right now, okay? Back in the 90s, I did. That was the last time I saw 6.45 in the CD world. So you can see the interest rates are way better than CDs, way better, full percent better. Okay, 6.45, simple interest. You take that interest and enjoy it. But the problem is, in this case, the top one, there's no access. So you're going to have to go down to 6.05 if you want access. 7 years, you can get 6.7 with no access, 6.2 with access, compound rates right here, 6 to 5.6. And 10-year, the best thing out there is 5.9 with no access, 5.5. There's no simple interest options out there that I'm seeing right now. So that gives you some perspective. These multi-year guarantee annuities are simply a fixed interest rate for a fixed period of time. They're exactly like a CD. And we went through all the pluses and minuses and differences. And again, it was AI that came up with it. And AI was pretty darn accurate. I was very surprised. So I hope that demystifies the whole multi-year guarantee annuity world. It is in a lot of people's portfolios, especially those people that are in or near retirement. That's where those things are really shining. So those, whatever stigma you may have, these are tools that can be used in your portfolio. All right, if there's anything I can help with, yourinvestmentcounselor.com. You can jump on there and schedule a meet and greet with me. And feaz.org has our full class schedule if you're looking for more education, all focused on financial planning, especially for people heading towards retirement. Give us a call if we can help in any way. Join our full classes. They're fantastic. And like, share, do all those wonderful things with this video. And we'll see you next week.